Okay, so this one is 2004 paper 1 question 7. So this one, it says Jane and Kathy were in partnership sharing profit and losses in the ratio of 2:1. The firm's balance sheet at 30 September 2004 is as follows. They decide to admit Laura on 1 October 2004 as a new partner. Jane, Kathy, Laura agreed to share profit and losses in a ratio of 2:1. It was decided that before Laura was admitted, the following would take place. So that means they are bringing, before Laura is admitted, um, everybody, the especially the old partners, want to bring the asset to the current fair value, including, put a value to the goodwill that was generated by the old partner. So the question asks you to prepare a revaluation account, a capital account, and a balance sheet. So what is this revaluation account? So previously I have explained to you that when a new partner come in, especially the old and existing partner, they would want to bring all the values of the assets, and also they want to assess the value of the goodwill that they have generated for the business, because the old partner are the ones who bring the business to what it is today. Okay, probably when they started to do business a few years ago, the the value of their premises, the motor vehicle was at a much lower value at that time. And today, all the value of the assets mostly have appreciated, and also they have generated a good reputation, so-called goodwill for the business now. So all the um increase in value minus any decrease in value of any assets should be due and given or credited to the old partners old partners capital account. So, but there are so many things here. You see, the purpose of, also you have your question paper in front of you. The purpose of a revaluation account is to make everything more tidy. So you see, you are supposed to prepare a capital account. You can credit all the increase, you can credit all the increase in value of premises, and then you can debit all the decrease in value of any assets to your capital account. But then it will be quite messy to deal everything in the capital account, though it is possible. Okay, so then now we do a separate account called revaluation account. This revaluation account will not appear in your balance sheet, but this revaluation account is just to credit all the increase in assets into the revaluation account and debit all the decrease in the value of assets to this revaluation account, and the difference we will transfer to the capital account, so that the capital account would have less items and it will be neater. Okay, so this is what you mean by revaluation account. So in the question it says that premises would be revalued at 90,000. So you see, in the question here, the premises is 62,000. It is revalued to 90,000. So that means the increase in value of premises is 28,000. Okay, so this one, the revaluation account, is so-called bridging account that will ultimately transfer the value to the capital account. So you see, the capital account of the partners is capital in nature. So that means what we understand is we treat capital account of partners as if it's something like your creditor's account. That means the business owes the partners the capital, owes the partner the money. So capital account is something like a creditor account, where the credit side means the business owes the partner the money. So if I am the partner, if you credit my capital account, I will be happy, because that means that means the business owes me money. In other words, I have more money. I have more money in the firm, in the partnership, okay, in the business. Okay, so if I put myself in the shoes of the partners, if you credit my capital account, I will be happy. If you debit my capital account, I won't be happy. So revaluation account is intermediate account that will accumulate all the increase in asset or decrease in liability, and it will debit all the decrease in asset. Then the net figure will be transferred to the capital account. Okay, so that the capital account will look neater. Okay, so in the question it says that premises are revalued at 90,000. So the premises value in the balance sheet is 62,000. So that means the increase in value in the premises is 28,000 credited to the revaluation account. So goodwill account would be goodwill account of 7,005 would be open. Okay, goodwill account is 7,005 would be opened. Okay, you see, previously I have been telling you that for goodwill, if the question says goodwill should not appear in the balance sheet or something to that extent, then we will credit the goodwill to the old partner in the old profit sharing ratio and debit to the new and ongoing partner in the new profit sharing ratio. That if the question tells you that goodwill account should not appear in the balance sheet, or goodwill should not appear as an account, something like that. But here says something opposite. You see, it says here a goodwill account of 7,005 would be open. What this means is a goodwill account of 7,005 will appear in the balance sheet as goodwill. This is what it means. Okay, so if the question says the other way around, like what we have learned before, a goodwill account should not appear in the balance sheet, or something like should not appear as an account, that means the goodwill should not appear in the balance sheet. But this one says a goodwill account of 7,005 would be open. So that means the goodwill will be credited to the capital account via the revaluation account. So that means the revaluation account is an intermediate account that would eventually transfer to the capital account. So we will credit the revaluation account 7,005, and we will debit the goodwill in the balance sheet. We will debit the goodwill account that will ultimately transfer to the balance sheet. Okay, so that means we will debit the goodwill in the balance sheet 7,005 and we credit the revaluation account. Okay, then in the question it says that provision for doubtful debt 5% would be created. So provision for doubtful debt is will reduce the debtors figure. So that means provision for doubtful debt will decrease your asset. So you debit it to the revaluation account. Okay, so in the balance sheet in the question, debtors is 8,000. So provision for doubtful debt is 5%. So provision for doubtful debt will be 400. Okay, then the next point, it says that Laura car would be used as a business asset. It is valued at 9,000. So that means Laura brings in capital of 9,000 into this partnership by way of a car. Okay, it's not by way of cash. So that means instead of bringing cash money into this business, she bring in her car. So it's also indirectly bringing money into the company. So you will credit Laura's capital account 9,000, and you will debit the fixed asset motor car. Okay, motor car 9,000. Okay. Then Laura would pay sufficient funds into the business bank to make her capital equal to Kathy. So this one we hold on first. Okay, so this one, car, motor car. Okay, you see the first point here. Promises would be revalued at 90,000, stock at 18,000. So that means stock will reduce value by 4,000, and motor car 27,000. So that means motor car will reduce value by 35 minus 27,000. That is 8,000, and then stock will reduce in value by 4,000. So this will be debit to revaluation account. So then now you close the revaluation account. You see which side bigger. Okay, this side bigger, 33,500. I put the same number here. Then 33,500 minus all these, I get 23,100. 23,100. Okay, then you divide by the profit sharing ratio of Jane and Kathy is 2:1. So that means Jane will share 2/3 of this revaluation of this 23,100. So 23,100 times 2/3, you get 15,400. And 23,100 times 1/3, you get 7,007. So this figure will transfer to the capital account. You see, Jane 15,400 and Kathy 7,007. Okay, so then now in the last point in the question, it says that Laura will pay sufficient funds into the business bank account to make her capital equal to Kathy's. So then now we try to close the capital account of Jane and Kathy first. So you add up these two figures. So the balance carried down for Jane and Kathy will be 75,400 and 37,700. That's how you close your capital account, because these two figures, actually you should draw a line and then put the number here. Then this will be the balance carried down. Okay, so Laura's balance carried down will be same as Kathy, like what the question says, because Laura's capital account should be same as Kathy. Okay, so you put 37700 first, put the same number here. 37700 minus 9,000, you get 28700. So the question says this 28700, Laura would pay into the business bank account. Okay, so I put here cash. You can put here bank also, yeah, because that means in other words, you are debiting bank, okay, and crediting Laura's capital account. Okay, so you can either put this description as cash or bank, or cash less bank, so it's okay. So the capital account balances you transfer here into the balance sheet. Okay, then this bank loan is 14,000, creditors is 17,000, is as given in the question. So the bank figure, you see in the question is a bank overdraft of 6,000. Okay, but Laura paid 28700. So that means the bank figure would be a positive 22700. Okay, 28700 is what Laura banked into the business bank account. So now the business bank account would change from a bank overdraft of 6,000 to 22700. Okay, stock as given in the question, the revalued or the revised stock figure is 18,000 as given in the first point in the question. Motor car, the revised motor car figure as given in the question is 27,000 plus 9,000 is what Laura brought in, her new motor car. Then promises, as in the first point, the revalued figure is 90,000. Okay, debtors less provision. Okay, debtors in the balance sheet in the question is 8,000 minus the provision for doubtful debt 400, you get 7,006. So that's how I get all the figure in this balance sheet. Okay, so now as you see, the more you do, the easier it is. Okay, thank you.